Welcome back to another video. Today we're going to be looking at the housing inventory in the United States, as there are now over 1 million homes available for sale, and these are numbers we haven't seen in around 5 years. I want to touch on how this could impact the housing market over the next 2 to 3 years, as well as take a look at new homes available for sale, which is new construction, and kind of see how that compares to existing home sales. There is starting to be some confluence lining up between the two of them. I also want to touch on my expectations for the overall housing market over the next 2 to 3 years to give you a better idea on how to navigate it and what to look out for to discover which direction the housing market could be going. If you're new to the channel, my name's Ian Phillips. I'm a realtor in Southern California, and I love everything housing data, so I'm uploading weekly videos diving into the housing market, giving my expert analysis on where I think things could be going, because there is a lot of question marks surrounding the economy and the housing market. And I love discussing what's going on in the economy and how that will impact the housing market. So if you like this video, subscribe for more, and let's get straight into the data. So this is housing inventory for existing home sales, which means not new construction. So this does not take into account all the new builds that are available for sale as well. And as you can see, there are now 1,036,000 homes on the market as of May 2025. And I do expect this to continue increasing. And what's very interesting is we haven't seen these numbers since December of 2019, when we started to enter this inventory crunch where there were almost no homes on the market. And then we saw 2.5%, 3% mortgage rates, which caused the inventory crisis to exacerbate. And when we bottomed all the way back in March of 2022, with 354,000 homes available for sale, the lowest on record since the data started being tracked. And if you're unaware, that is kind of when the overall housing market peaked, back in 2022, when we started seeing mortgage rates around the 7.5% range. That's sort of when buyer demand started declining, and we got a pretty decent correction in the housing market, with prices dropping around 10 to 15%. Now, where I live in Southern California, the coastal market got hit even harder, some areas dropping 15 to 20%, but more inland cities, they kind of held up a little better. And now I know what you're thinking. In your local market, prices are continuing to hit an all-time high, and that is the case for a lot of cities around the country. Where I live, in my county, prices have hit new all-time highs. Since 2022, where they had a 15% correction, they're now 15% more expensive than the peak of 2022, while the overall country has actually dropped since then. So the housing market, while it is slow in a lot of the country, prices are still increasing in other areas. Places with high demand and low inventory still being an issue is causing prices to increase. Now, how long that's going to happen, it depends on your area. Obviously, the housing market is very local, but I want to touch on the overall housing market in this video and what to expect moving forward. So inventory hitting over 1 million homes for sale is the headline that we're seeing right now. And it's true, we haven't seen these levels since 2019. But what's interesting is new home sales, or homes available by the builder, sort of started indicating that we could see prices rising in existing home sales early on. You can see this has been increasing very steadily for over a decade. And now we are approaching the levels of the financial crisis, where there was the most amount of new builds available for sale on record. So if this continues increasing, which I expect it to, there are a lot of issues going on with home builders right now not being able to sell their homes and offering the most incredible discounts and incentives to get buyers into their home building sites. But I do expect this to continue increasing, which in turn will likely increase the existing home sales on the market as well. As if you're a buyer jumping into the housing market and you're in an area where there's a lot of new construction, it's kind of a no-brainer to buy a new build because of all the incentives and discounts that they're offering. Relative to what's on the market, you're going to have to pay your own closing costs. The house is probably more expensive than the new build already, because for the first time in history, a brand new home is actually cheaper than an existing home of the equivalent size. I am familiar with this in my area, as I'm in escrow on a new house that is $200,000 to $300,000 less than the identical home that is available for sale on the market. So pretty interesting to see that dynamic starting to happen in the housing market. It's not something that is typical, but if this continues to increase, I do expect existing home sales to also increase. In fact, what's very interesting about homes available for sale is if you look at the state-by-state data, Texas and Florida has seen inventory absolutely skyrocket and is now actually higher than these levels over here. Homes available for sale have hit a 10-year high in Texas and Florida, and together, those states make up 40% of all homes available for sale on the market in the United States. But when you look at places like California, which inventory is increasing, 73,000 homes available for sale, it's nothing compared to Texas, which is approaching 200,000 homes available for sale, and Florida, which now has 230,000 homes available for sale. So while California is increasing and sort of in line with the overall United States in terms of where we're at, so this is 73,000, and back around November 2019, there were also around 70,000 homes available for sale, which is kind of timeline-wise exactly where we are for the total housing market. You can see May 2025, 1,036,000, and then December, sort of the same inventory. But Texas and Florida are hitting a 10-year high, and in my opinion, it's probably going to continue increasing. So where does that leave home values and what you can expect moving forward? Well, inventory is a huge impact on what home values do. And an issue that buyers are seeing right now is affordability. The mortgage rates have stayed elevated for the last 3 to 4 years, around 7%. And a lot of people have been expecting them to decline, get into the low 6s, high 5s around this time, and it just hasn't happened. So all of those people who bought with 2-1, 3-2-1 rate buy downs are stuck with a very high mortgage rate, and a lot of those previous buyers are putting their homes on the market. Now, the issue, in my opinion, is there are just so many buyers waiting on the sidelines for mortgage rates to finally drop. And when they actually drop, it'll be interesting to see how buyer demand reacts. If mortgage rates get into the low 6s, do we start seeing a lot more mortgage applications, or do we need them to get into the mid to high 5s for mortgage applications to actually start increasing in a durable fashion? Because if it's just a slight increase, it's not going to do anything to this 1 million homes available for sale, especially if it continues increasing. So it's going to be very interesting to see how everything plays out. Now, what do you need to be keeping an eye on for mortgage rates and determining what is happening in your local market? Well, first off, your local market is going to be very different from what the overall country is doing. And you need to be keeping an eye on months' supply of inventory. That is the perfect determining data set for buyer demand as well as housing inventory. It takes into account number of homes available for sale relative to number of buyers that are in that market. So month supply of inventory is the key factor. And as far as mortgage rates, determining when buyer demand could start increasing because of it, you need to be keeping an eye on the unemployment rate and the inflation rate. If inflation continues to show signs of going back down to 2%, hopefully under 2%, that's going to give the Federal Reserve a lot more confidence with cutting interest rates, which in turn should help mortgage rates decline. Now, unemployment is another major factor that the Fed is waiting for to determine how often and how large the rate cuts are going to be. In my opinion, they need the unemployment rate to be back above 4.5% and potentially approaching 5%. As of right now, the unemployment rate is still at 4.2%, which is a historically low number on average. So if we get the unemployment rate increasing in the second half of the year, then we could actually see multiple rate cuts happening before 2026. As of right now, there's only 2 rate cuts anticipated for the second half of this year, and 2 to 3 rate cuts before summer of 2026. So potentially we see low 6s in the second half of this year for mortgage rates, and then mid to high 5s by summer of 2026. Now, if anything changes with the unemployment rate skyrocketing, expect rates to decline rapidly. The Fed does not want to be in a situation where where unemployment starts to increase too fast and then they've cut rates too late to stop it. Remember, the unemployment rate can get out of control very quickly unless the Fed cuts rates multiple times and does large rate cuts. That's what happened in the financial crisis. Unemployment was skyrocketing. The Fed was too late to cut rates, and we saw unemployment hit 10%. Now, I don't think that's going to happen again. I think for house prices, what you need to be keeping an eye on is supply and demand in your area, which is month's supply of inventory. If you like this video, subscribe for more and let me know your thoughts in the comments. Where's the housing market going to be going over the next 2 to 3 years? I'll see you in my next video.